My name is Karen Gabet. I'm here today with Giselle Comissiong, Head of Marketing and Communications at LFIS. And we will be talking about risk premia investing. So Giselle, let's start with the basics. What is a premia?
The existence of premia have been documented in academic research going back decades. And the term that's most commonly used today is risk premia, but there are actually two types of premia strategies. There's risk premia, which compensate investors for taking on additional economic or financial risk. And then there's style premia, which compensate investors who are able to put into place strategies that benefit from certain structural market biases, whether behavioral or linked to investment constraints or flows.
Could you give some concrete examples maybe?
Sure, absolutely. So perhaps the best known risk premia is the equity risk premia. And this is the additional return that equity investors expect above the risk-free rate in exchange for taking on board equity risk. Another common premia is the value premia. And here it's been observed that less expensive or value stocks tend to outperform more expensive stocks over time. This is a premia. To capture the value premia, you would buy the less expensive or value stocks and you would sell the more expensive ones. To give you an example of pure style premia strategies, these would be arbitrage strategies that seek to take advantage of inefficiencies in pricing across different markets for the same underlying asset. And this is typically simply linked to the fact that certain market participants can't hold the underlying asset in question.
So do you always have a long-short approach when implementing a premia?
Yes, so premia investing is always long and short. And this is different to smart beta, which implements only the long half of a premia strategy. So by definition, premia strategies have two performance engines, the long leg and the short leg, and they're market neutral.
So why should investors consider a risk premia strategy?
Well, it really is a different approach. So the 2008 financial crisis hammered home the fact that the majority of investment funds, including hedge funds, tend to be overexposed or highly correlated to equities, especially in times of market downturn. And this is because they're overexposed to a single risk factor, which is the equity risk factor that I talked about previously. So clearly investing across different asset classes or different investment funds simply isn't enough. It's our view that the only way to deliver truly diversifying, decorrelated performance is to make sure you're investing in different premia rather than focusing on different asset classes or investment fund types.
Now, LFIS often refers to its approach as Premia 2.0. What does that actually mean?
Well, I can sum it up in a word, so diversification. LFIS launched its first premia strategy in 2013, and we were actually among the first in the market to take such a broad approach. We do invest at LFIS in academic premia, which are the most common premia, but we do so across asset classes, including currencies, fixed income, and commodities, in addition to equities. But academic premia are only the tip of the iceberg, and it's actually the other premia strategies we implement which make us unique. So we also implement implied premia strategies, which are on less conventional asset classes like volatility, dividends, correlation. And we implement a third family of strategies, which is the liquidity or carry premia. And here we get compensated for holding a liquid asset that others in the marketplace simply cannot hold for regulatory reasons, most usually, whether it's Solvency II, Basel III. Now, these strategies have been implemented by investment banks for years, and they require a strong derivative setup and capabilities. And they may sound abstract, but they're actually backed by structural market flows and an active market of buyers and sellers.
So why is it important to implement a broad premia approach?
Our research at LFIS has shown that the holy grail of premia investing is the ability to combine as many uncorrelated strategies as possible. Why is this important? Well, even though statistically each premia is shown to deliver performance over time, it may take some time for a given premia to materialize. So it's therefore interesting to have as many different premia strategies as possible in your portfolio. Secondly, when you combine uncorrelated strategies, two things happen. First, their individual performance contributions are additive, but the fact that they're decorrelated dramatically reduces the overall volatility of the portfolio. And it's these principles that underline the absolute returns and the strong Sharpe ratios that we seek to deliver.
And how is LFIS able to implement a broad approach like this?
That's a good question. LFIS's portfolio management, quantitative research, and risk management teams number more than 15 professionals and bring together complementary expertise from quantitative asset management and investment banking. So you combine this with LFIS's full capital market setup, and we have both the market access and the expertise to implement the wide range of premia strategies. We don't need to outsource, we implement all of our premia in-house.
So how do you select each premia, and more importantly, how do you allocate amongst the various premia?
So each strategy we look at has to be quantitatively and qualitatively screened before it can be included in the portfolio. And this is to make sure that it's robust and sustainable, among other important features. We also take great care and we spend a lot of time making sure that we aren't exposed to any hidden beta, and we tend to favor strategies that increase the overall level of diversification in the portfolio. When it comes to combining the strategies, we take a simple but robust approach, which is the equal risk contribution approach. And here we divide our overall risk budget or volatility budget into an equal allocation for each underlying strategy.
So how do you manage risk within the strategy?
So our approach to risk management can be summed up in the phrase, don't put all your eggs in one basket. Because we target such a vast universe of strategies and we look to combine uncorrelated strategies, it's very unlikely that any single position in the strategy could have a significant impact on overall performance, whether positive or negative. We monitor risk on a daily basis, including drawdown and concentration limits and stress testing.
And is it fair to say that your approach is systematic then, rather than conviction-driven?
I think what's fair to say is when it comes to Premia investing, we believe that the power of diversification is greater than the power of prediction. We don't try to predict markets, we use models to screen markets, look at the range of asset classes and identify Premia opportunities. And our investment process and our risk management processes are similarly quantitatively driven, giving us a consistent, repeatable roadmap for performance.
Now, my last question, Giselle, how does a strategy like this fit into a traditional portfolio?
Well, the power of our strategy is its ability to act as a diversifier in a wide range of portfolios, and this is an important point. Because we focus on investing in different premia rather than in different asset classes, this makes our strategy a diversifier versus the range of other investment fund types available.
Giselle, thank you very much for your time, and thank you for giving us an overview of Premia investing at LFIS.